individual sectors in terms of earnings, what the outlook is on the markets, and how one should be positioning themselves. Sanjay Mookim is India equity strategist at BofAML, who now joins in on the show. Great to have you on board, Sanjay. And just, let's start off by dissecting individual sectors when it comes to earnings by beginning with the auto space as a whole. In the report, you go on to say that it's four-wheelers that's preferred over two-wheelers on account of lower stress in the system. Can you just walk us through what the expectations is when it comes to margins, when it comes to volume growth, as well as overall demand?
Good morning. Good to be here as well. Look, the whole space in general has gone to a surprisingly sharp correction. And if you walk back 6 to 9 months, nobody really had seen this sort of a slowdown coming in terms of a demand weakness. And as you know, we've seen sell side behavior. Typically, people tend to underestimate the margin effects of lower volumes, the operating leverage for many of these companies. So at least my sense from a strategy point of view is that in the near term, as volumes remain weak, you are likely to see margin disappointments in some of these companies as well. However, what we have seen is significant inventory reduction. Companies have been disciplined, they've been cutting their production, trying to push sales through discounts, and inventory numbers have come down faster possibly at four-wheelers than at two-wheelers, which is really what is driving our preference at the moment. But my worry is that from a broader strategy point of view, as long as this demand weakness continues, you have risks of earnings disappointments because people don't anticipate the operating leverage too much or too well.
Sure. Sanjay, let's talk about telecom. I mean, that's a space where you're actually seeing perhaps some improvement. Does that mean you're looking at perhaps increasing any exposure there, given that, we have seen fundraising aggressively, even on the incumbent Bharti Airtel, in fact, having a good run, even in terms of stock price, for example. What's your sense there?
Well, look, we are underweight the space still, and if you think about the fundraising that a couple of these companies have done, the ability to last longer or to have more capital effectively allows for the competitive pressure to continue for longer, right? And there will be question of which can survive and can they survive the sort of pressures that they are seeing on their EBITDA and cash flows. But the fact that they've got more money, that means they have longer staying power. So conceptually, at least, it means that the competitive intensity can stay higher for longer. Okay. I think the question for telecom really is that the new entrant in the space has a lot of firepower, and a lot depends upon how that new entrant behaves in terms of taking pricing up for the whole industry.
Okay, so that's on telecom then. Overall as well, Sanjay, what do you make of the recent slew of factors at play? Elections, earnings, and now we've got crude also, being thrown into the picture there.
Well, look, we are very clear on what is driving the market at the moment. And while we would like to, sitting here in Mumbai, talk about everything that is intrinsic to the economy and what's going on locally, what effectively has driven the market up is the big EM rally. Starting the end of December, when global central banks, especially the Fed, turned dovish and they've brought down interest rate expectations globally, there has been a big flow of money into emerging markets. This is driven by a growth differential, or at least a perceived growth differential from investors, where the US economy, there is concerns of a recession or a growth slowdown, whereas for the Chinese economy, there is expectation that it is stabilizing and possibly even accelerating, given the big stimulus that we've seen in China. So this growth differential that we're seeing between largely China and the US in terms of forecasts is pulling money into emerging markets, and India has been a beneficiary of that sort of flow. And in fact, if you look at the correlations for a variety of categories, it's very strong in this rally, again kind of reiterating the fact that this is a top-down macro rally in India, not something to do with domestic politics. We've seen India underperform a couple of instances over the last 6 to 8 months. One, when oil prices were rising, and then India caught up again when oil prices fell. And secondly, India underperformed given the elections and the uncertainty on politics, which also there has been a catch-up post the incident on the border. Right? So there has been increased volatility in Indian equities, but the trend really has been driven by what is happening to emerging markets. Now, I argue that the setup for Indian equities is not very favorable at the moment, because having rallied at the moment, we have little upside on the event. Should you get an unfavorable political outcome end of May, the markets may correct anyway. But should the markets get what they want for, there is not much to look forward in terms of a change of growth trajectory anyway.
Right. Sanjay, what's the view when it comes to the overall industrials basket? Do you think that we can see, on account of the fact that it's going to be the election this time around, that there is a case for, an improved order book outlook, or things improving on ground, thereby benefiting the likes of L&T, BHEL, etc.?
Well, we've done a lot of work on this, and we've highlighted that increasingly the industrials complex or the companies are not necessarily reliant on the central government's budgeting exercises for order flows. A lot of the orders that the government itself is placing is coming from finances that are outside the budget, and increasingly state governments are becoming larger drivers of orders for many of these companies. So we really do not find any evidence of inflections in and around elections, and we think that if there was any correlation, that is even getting diluted at the moment. So our sense is that the order flow in the industrials complex should remain steady at the low double digits, irrespective of the elections turning either way.
Okay, fair enough. There's been extensive talk about the outlook within the overall consumption basket. A lot of experts were pinning their hopes on strong growth going over here. But do you see that flailing a bit? What exactly is the outlook when it comes to some of the mid-cap consumption themes as well?
Well, look, I think the way to characterize this is that the consumption basket in India is, for once, not moving in unison. Right? There are pockets which are doing well, and there are pockets which are doing very poorly. And this could partly be explained by what is happening due to the GST. We've done a lot of work on this ourselves. We've had a lot of conversations with small and mid-cap companies in India, and it seems that businesses that are micro, that are below the GST cutoff, are not doing very well, but businesses that are larger than the GST cutoff, or which have more scale, which are more organized, are doing pretty well. Now that could partly explain the sort of slowdown we are seeing on the consumer discretionary, but GST is also driving, I would argue, some sort of market share shift from the unorganized segments for certain segments, not for all of them. So as a result, there is this sort of mixed feedback for consumption in India. In general, Indian consumer businesses continue to grow 6 to 7% a year. Indian consumption is actually relatively stable.
All right, Sanjay, appreciate you taking the time out and joining in, giving us a view on the all-round earnings analysis as well as market outlook.